Welcome to Innovation Day 2023, presented by Connect. We've got such an incredible array of things happening here, supporting the life sci and tech communities in San Diego.
Thanks everyone for coming to the session today. I see some familiar faces here. I'm just curious, can everybody do a show of hand so we know the audience? How many of you here are entrepreneurs? Investors? And people with large companies from the industry? All right, so it's a pretty polarized audience, looks like. All right, so here we go. So I think for the first couple minutes, we probably should have Jeff and Aiden just do a quick intro of yourself. Then we dive into questions.
Sure. I'm happy to kick it off. Apologize if you guys were here to see Valentina. She's a good friend. She's not feeling well, so I'm filling in. My name is Idan Levy. I'm an investor at Fika Ventures. We're a early stage venture fund based in Los Angeles. Early stage, really the earliest stage, so pre-seed, seed stages. Currently investing out of our second fund, which is a $50 million fund in software and tech-enabled businesses. So a couple of the kind of categories and focus areas. We do a lot in capital markets infrastructure. We do media tech. We do workplace innovation, and then future commerce. So those are kind of our four verticals. And yeah, check sizes range from $500,000 all the way up to $2 million.
Jeff?
Hey everyone, Jeff Diamond here from Fika Ventures, another LA-based fund. We are a pre-seed seed and now doing some Series A. Generalist fund, but enterprise SaaS and fintech has sort of been the core of our investment strategy since the inception of the fund in 2016. But we also invest in construction, prop tech, dev tools, healthcare, applied AI. Usually at $1 to $5 million first checks, and usually lead or co-lead our rounds.
All right, thanks. So I'm Albert Wang, Senior Director Venture Investment at Qualcomm Ventures. So Qualcomm Ventures is a corporate venture fund for Qualcomm. We have about $2 billion under management and about 200 active portfolio companies today. We invest in all kinds of sectors, mostly looking through the compute platform perspective, mobile, IoT, cloud, AI, AR, VR, robotics, automotive, so anything that touches the compute, right? So I guess between, among three of us, we see a lot of different sectors. What excites you the most?
You want to kick it off?
Sure. I guess I'll start where I spend the most amount of time, which is healthcare and applied AI, but specifically looking in media right now. I think with healthcare, what's sort of astonishing is that as a country, we spend the most on healthcare, but compared to other developed countries, our outcomes are not as great. And what we're seeing is the ability of AI to really affect care in ways that allow for more transparency, affordability, equity. So for us, we're seeing a step change in healthcare and other industries where AI is making the adoption of technology more accessible. Within healthcare, we sort of looked at three areas that we're particularly excited about. We think about point of care technology. So think about personalized treatment, differential diagnosis, medication management. Thinking about reimbursable opportunities. So price transparency, prior authorization, utilization management, or life sciences, drug discovery, genomic prediction. These are areas that we're extremely excited about, that AI is elevating, accelerating the pace of these areas. So that's an area that we're spending a ton of time in and extremely excited about. And then the other area, my background, I spent a decade in the media and entertainment industry before becoming a venture capitalist. And this being in LA, our fund hadn't done a ton of media investments, but it kind of behooved us as Gen AI was also creating a step change in that industry of adoption that we need to be paying attention here. And it was good to tap back into that sector where I spent so much time and also realize that investing in that area wasn't sexy for a long time. And Gen AI has really opened opportunities back up and got people excited again. And to me, the most exciting thing in this space is the democratization of tooling that tier one studios are having and bringing those to independent artists. Incredible companies being made, production and post-production with 3D environments, CGI, VFX, sound mixing, motion capture, all these amazing technologies you see in the Hollywood blockbusters now at people's desktop. And so I think where we're looking is where Gen AI is having that impact to create better content and more content.
Right, Eden?
Super interesting. So I have a background I'm a former engineer myself, started my career, my first 10 years of my career, I was working in enterprise IT. So not as exciting stuff. And as such, I actually get excited about the unsexy businesses. So these digital transformations that are taking place in legacy industries, you think about construction tech, you think about supply chain and transportation, and some of these industries where have been operating on pen and paper and Excel spreadsheets for decades. Technology is finally coming to the forefront. And sure, there's some AI solutions, but even just automation and technology workflow solutions that are connecting the different players and the different stakeholders in these supply chains in new ways, in more efficient ways, and being able to deliver their solutions faster, that's what excites me. So it's very often, I see a deal that it's something that seems like it's out of left field, a manufacturing plant for commodities or climate risk impacting supply chains for transcontinental logistics, and that's what excites me. When you see technology being applied and bringing new innovation and new efficiencies to these old legacy processes that, quite frankly, the world operates on.
And I think, just to add, I think Idan is spot on that it's not just AI, it is automation, but the idea now that the accessibility of AI, that people need to be thinking about how to integrate this infrastructure and this tooling into their businesses to accelerate their businesses is super important.
So in the past few months, right, I think we all observed this interesting phenomenon. There's a haves and have-nots in the startup community. You have a lot of AI startups, especially Gen AI startups, getting sky-high valuation, where a lot of other startups who don't necessarily do AI, what doesn't have AI of their focus, they struggle to raise funding. Do you see that in the market, and how do you deal with that?
Yeah, I'll take a stab at it. I think, you see these hype cycles, quite frankly. You saw this, about 2 years ago in 2021 with NFTs and the NFT craze and the Web3 craze, and there is a little bit of chasing this shiny object. That, to me, is not success. Just because you raise at a high valuation does not mean you have a successful business. And what I tell entrepreneurs all the time is that you need to focus on building a business, not worrying about what investors think or worrying about what valuation you're going to get. At the end of the day, you need to prove that you have a product that you can sell, that you have customers that will pay you for it, and that you can scale, and that you can do it over and over and over again and grow. And in the long run, somebody that has that is going to be successful. They're going to have the business that survives and lasts and grows. And the person that got the high valuation because they had the juicy, sexy, shiny object that all the investors were chasing at that moment, if they can't deliver that, it doesn't matter. So yes, you definitely see that's just the nature of humans, I think. And we've seen it in the past. We'll see it again in the future. Right now it's AI. But I try not to get caught up in it, and I encourage everyone here not to look too much into that.
Yeah, I think that's spot on. I think one of the things we think about at our fund and we share with investors and we give feedback is think about who you're building for. Who are your stakeholders, and how are you going to get from 0 to 1 million, 1 million to 5, 5 to 10, 10 to 100? What are those steps that you need to take to get there? And now, this correction that has happened in the market, I think, is a really good thing. It's making founders and investors more judicious about focusing on profitability over growth at all costs that had existed for some time over the last few years. And now, at least for us, we're hyper-focused on our portfolio and paying attention to how our portfolio grows and how we need to help them with operational efficiencies and cash flow and make sure that they are growing effectively. And competing on price while also keeping margins at a level that are competitive and will help them get to the next fundraise.
So all that sounds good, but what if, like, as your question say, do you observe any slowdown in the pace of investment in respective funds?
The short answer is yes. There's been a major slowdown this year. And listen, it trickles down from the public markets and what happens there, and then it goes to the later stage and the middle stages, all the way down to the earliest stages where we operate. What I say is the capital's still there. Funds have been raised, and we have investors. We as investors, we're constantly looking for new investments. We're very active right now. I'm dying to make an investment. But what's happened is over the last few years, people overextended themselves and maybe moved a little bit too fast and over-allocated. So now they're slowing down. So what to expect as a founder that's potentially raising? Expect longer cycles. Expect the diligence cycle, something that might have taken 6-8 weeks for a fundraise now is going to take 12 weeks, 16 weeks. Expect the investors to say, you know what, I want to see this pipeline convert a little bit. I'm gonna sit and wait a little bit. So it is a slowdown. I think to Jeff's point, I think it's a good correction. I think it's going to force a lot of people to focus on business fundamentals and operating in a capacity to actually grow with your revenue versus just burning capital and just spending money without actually getting ROI on those dollars that you spend. And it's an adjustment that everybody needs to kind of get comfortable with. For us, again, we want to invest. As investors, that's our job, is to invest. So it's not that we're no longer looking to invest, but the difference is, some of the later stage funds, when everyone was moving 100 miles an hour, everyone started going earlier. So the Series B funds started doing Series A deals, and Series A funds were doing seed deals, and seed funds were doing pre-seed, which was great as a founder. It seemed like, because there's so much capital, so many investors that were interested, right? Now, those funds are going back to their bread and butter. Series B funds, they're not doing Series A's anymore. They're only doing Series B, and they're like, I need to see these metrics. The investments that I made when I moved so fast and tried to overextend and go earlier, they're not shaking out the way I expected. So I'm going to go back to what I know. So with that means that there's a little bit less competition on the investor side, right? So it's a little bit more difficult for the founders that are fundraising because of that. So it is a slowdown. It will come back. Mm-hmm. The capital's out there, but you need to work on your story. You need to build a business and focus on the business fundamentals at the end of the day.
So Jeff, when you address the question, can you also talk about what founders can potentially do differently to make a fundraising process a little easier in this environment?
Yeah. Well, first of all, I think Idan said it perfectly about sort of urgency and understanding, like from a founder's perspective, understanding how venture firms are looking at this market. And I guess I'll use the lens of, again, we're not an AI fund, but we focus so much on it. So I'll use that as an example to answer this question of there's an extreme urgency to not miss a moment. And I think there's a lot of excitement around the technologies and the companies that are being built surrounding Gen AI especially. But we've taken the last, call it 6 or 8 months, to really educate ourselves on the market. We're a very price-sensitive fund. We're not a billion-dollar fund. And because of that, we're trying to understand where to place our bets. It doesn't mean that we're not actively investing. Like Idan said, we're eager to do deals. We're excited to do deals. And and founders should know that. But what they should be thinking about is the key items that we're looking for from them. So right now, we are over-indexing on founders specifically that have distribution advantages and networks built in to drive proprietary data access. Data has sort of become this catch-all that is fundamental to building endurable businesses. And so for us, founders thinking about where do they have advantages into the market? Where do they have advantages on their go-to-market strategy? Things I sort of touched on in the last question is, who are you selling to? Being able to convey this story very clearly is crucial. And also, as Idan said, it's becoming harder to raise additional rounds. It's a trickle down from the top down. The macro environment has crunched multiples for public equities companies which has affected Series B through D's companies and them having down rounds or having to recapitalize, which has ultimately put pressure on Series A and earlier startups and the expectations for their next raise. So I think understanding the realities of the market and the difficulty it is to graduate to the next round, and how investors are being more diligent and more discerning about where they're making their bets is critical for them.
Yeah, I got a couple other, I fully agree with what Jeff said, and a couple other kind of ideas and thoughts on on how investors think, right? So one of the things that comes up often is founders want 24 months of runway, 36 months of runway. And you know, I get it, like I do too, right? It would be great to have that comfort. The reality is we're in a high risk business. As a founder, you are in the highest risk business, and you need to have that risk appetite. And especially at the earliest stages, the pre-seed, seed stages, you know, I tell founders, I'm like, if I gave you $3 million today, what would you even do with it? It would be sitting in a bank for 24 months. I, as an investor, want to know that when I give you capital, you have a plan for it. There's going to be ROI on those dollars. And the business is going to look like, today looks like A, and tomorrow it's going to look like B, because we're going to invest these dollars in this way. So I think there's a little bit of it's always going to be a push and pull between the investors and the founders. Founders want more capital, more runway. Investors want less capital, keep it tighter, a tighter leash. But that's one of the things that a conversation that comes up over and over again. Another thing, you know, in terms of talking about the founders, right, and how do you differentiate as a founder? One of the things that we look at is the founder business fit. So I think it's a huge competitive advantage when you have a founder building a business in an industry that they have experience in. They know the problem, they saw the problem, they might already have relationships and inroads into those customers. That is one of the biggest boxes that we look at, right? I think it's super, super important building something in an industry that you know. And at the end of the day, we say it all the time, and I'm sure Jeff will echo this, we're in the people business. We're investing in people, and we want to get to know people. We want to get to know the founders. What's the chip on their shoulder? Why are they doing this? This isn't going to be a 12-month, 24-month fun little project. This is going to be a 5, 7, 10-year journey. And you're going to have investors by your side for a long part of that, right? So I encourage the founders, too, to spend time to get to know the investors. Are these people that you want to be in business with for the next 5 years? So, you know, we've never made an investment without meeting the founders in person. Even during COVID, the dark days of COVID, we found a way. We went on a walk with masks on. We sat in a park. You know, we found ways. And I encourage founders, you know, COVID got us all so used to this remote, do everything through Zoom. You don't need to meet in person. Get on the road. Go meet investors. Go meet your customers. Business gets done and is so much more effective when you meet people in person. And I can't iterate that enough. Go meet people in person. You have a chance to, whether it's a customer, an investor, a business partner, go sit down with them, even for 30 minutes, an hour, and you will be so much more productive. Makes all that progress that you've been trying to make, you'll get it done in those 30 minutes when you're in person with them.
And one thing I would add too, and I couldn't agree more, I think the in-person element is just, it's fundamental because, as Idan said, like, this is a long-term relationship. And I also think that if founders also understand from the investor perspective, let them take the time to do proper diligence. You want to do diligence on us, we want to do diligence on you to understand how this relationship will work. And I think it's been upsetting to see how some founders are just excited to just rush to get rounds done. And we understand that. You want to get back to building, you want to get back to focusing on your customers and your business. But if you are going to be involved in a fundraise process, like, get to know these people. And it will make so much difference. And for Fika, like, we're not going to do deals where founders don't want that. They're not prioritizing that. Like, we see that too. We see the effort that a founder will put into making the time for us to either come to them or them to come to us, introducing us to their customers and really making it, like, that's where the relationship starts. And nothing makes us more excited than to introduce a customer to a founder during the diligence process. And even if we don't invest, you have someone there who's going to be supportive of you and who thinks highly of you and could potentially introduce you to that next mega customer, that next or that next investor. And so it makes all the difference in the world. So any founders here today, I would just double and triple down on what Idan said about try to put yourself in the shoes of the investor as we try to put ourselves in the shoes of the founder and really think about that human-to-human element.
Yeah, I can't agree with you more on the importance of people factor, right? So as Southern California funds, how much do you emphasize on focus on investing in local companies versus maybe a lot of companies in the valley?
So I think this question was meant for Valentina, who's not here, because WonderVentures, primarily 90% of their investments are SoCal. So for us, look, we take pride in seeing everything in LA and in Southern California. We, all of us are based in Los Angeles. We do a ton in Southern California. In our first fund, I think 70% of our investments were in Southern California, in the greater Los Angeles area. In our second fund, it's closer to 40%. We do a lot in New York, San Francisco, Utah is a big area. So at the end of the day, I think all of us here in Southern California on the investment side are supportive of the ecosystem. And we want to see this ecosystem grow. We want to see unicorns emerge, companies IPO. It's a rising tide, what's the saying? A rising tide raises all ships. Yeah. So we want to see success. So we are very, very proud of being proponents and being part of the Southern California venture ecosystem. And we're very active in it. So I don't know if that kind of answers your question, but at the end of the day, we want to see it succeed. We host events ourselves. We come participate in events such as these, and we collaborate with other SoCal funds.
Yeah. I agree. At our core, we're an LA-based fund. And when we say that, we mean we want to be investing in the LA and Southern California community. I think in Q2, we saw really a surge of activity, which was really exciting here in LA from the investment standpoint and companies being built. There are amazing...
Was that around Gen AI?
No. Everything.
Okay.
Yeah, everything. I think one of the exciting things is there's these incredible companies that have come in to emerge in LA. SpaceX, Snap, Relativity. As a fund, we've invested in 3 ex-SpaceX teams. We've invested in teams out of the JPL. It's a breeding ground for talent. And while San Francisco may be sort of the AI R&D hub and really, it's crazy to sound like SF having a resurgence, but a lot of people thought SF was dwindling a bit during the pandemic and obviously has rushed back. LA is just, the diaspora's talent is incredible. And then down here in San Diego has been grounded in biotech, pharmaceuticals, semiconductors forever, but the amount of exciting companies, and I'll use AI again, that have been emerging, that have been raising big rounds, that have come into market, this is what it should be in Southern California. And with the amazing universities down here and communities like this that are bolstering founders, it's only going to make it stronger. And so at Fika, we could not be more excited about how LA and how Southern California is blossoming. And while maybe we still do deals all over the country and Canada, we are always hyper-focused on never missing a deal in LA and collaborating with the water towers and the other funds. And I think, LA Tech Week was a really great example of just a community coming together. I think the last 2 years have shown how people are excited to be building here and to be starting funds here. And I really have loved, and I'm relatively new to the LA venture tech scene, just the community is so strong and so supportive, so collaborative. And I think founders feel that, I think investors feel that, I think operators feel that, so that's really exciting.
Yeah, I feel like we can see it here, and that's great news for Southern California.
The other thing I'll add, I'm from the Northeast. I grew up in Boston, went to school in New York, and I think right now New York is the second biggest venture ecosystem, and it's driving me crazy. All right, San Francisco, fine, you can have it. You can have the late stage deals, whatever. Yeah. LA, San Diego, Southern California, let's go get it. Let's go get New York. Let's take them down, and let's overtake New York. All right?
There you go.
Let's get it.
All right, so we have a couple of minutes left. I want to see if there are any burning questions from the audience. This one. So the microphone is over there.
Quick question for the both of you. When you're doing due diligence for these AI companies, what is the litmus test that you're using to determine if it's a wrapper or if it's a real content? Because a lot of the founders I work with, when we're talking about story, narrative, pushing that narrative forward, I think they're not realizing that due diligence has increased quite a bit with these AI companies because they don't want to get burnt in the past like they have.
Got it. Again, I think for us, and we've talked about this a little bit today, it starts with the founder. And I think where I'll go, sort of follow me on this path here, is the founders building in an area that they know and thus having access to a network, a distribution network that provides them access to data, which that data drives better models. And that models drives essentially better technology and a better system. That's sort of our thought process as we're looking at companies and assessing, will they have a competitive advantage in the market? Because the tech for many of these companies is becoming commoditized. It's this access to distribution, it's this access to data, and how they will build off of that we see will have advantages as the threat of big tech is really real. And in so many different verticals, they're rolling out solutions to compete with smaller startups. And it's like, how are you going to build faster, go to market faster? So those are the things that we think about.
Yeah, I'll keep my answer brief, but one of the things that I always look for is proprietary IP. What's unique? What's proprietary? What is a competitive differentiation that nobody else has in their technology, in their solution? Is it the data? Is it the model that they're building? Or are they piecing together a bunch of off-the-shelf technologies, right? If they're piecing together a bunch of off-the-shelf technologies, well, guess what? Somebody else can also do that. And that's not very unique. That's not proprietary to me. So on the technical side, that's kind of what I look for, is I look for that proprietary IP, proprietary data, proprietary model, something that's in-house that nobody else has.
So one more.
Hi there. Thanks so much for coming out and sharing those words of advice. I'm John. I'm not a serial entrepreneur, but I did start a company, and I have some follow-on questions for some of the things that you guys said. One question is, for seed round, what kind of multiplier are you guys looking for in valuation? And the second question, love to hang out with you guys, but how do I find investors? Where do you guys hang out, and how? I want to hang out with you guys.
Here.
Right here.
So to your first question, I don't know that I have a good answer for you, quite frankly. I wish I could stand here and say that we take public comps and compare that and do a DCF for 3-5 years out and come up with the multiple and the valuation. The reality is at the pre-seed and seed stage, you just can't do that. You don't have enough data to do that. I would say you can look at what's going on in the market. PitchBook puts out reports. I look more at the dilution and the stage of the business and back into evaluation from there, right? Pre-seed rounds that are pre-revenue, you're looking at things that are 3 to 5, maybe up to 7 million if a company has an experienced founder. Things that are starting to generate revenue get up closer to 10. Something that's a couple 100,000, maybe they're 10 to 15, maybe it gets up to 15 to 20, but that's what I see. I'm one data point. I would encourage you to more look at what's going on and the companies that are getting funded and what the reports are saying. In terms of finding us, we're right here, man. Yeah, right after this, we'll go talk, all right?
I actually want to answer that part question a little bit. One of the best way to reach out to VCs is actually through their portfolio company founders. Build a relationship with them, and that's a great source of referral.
Yeah, I see we're getting kicked out, so I'll keep mine very short. What I would tell you is have a message and a reason for reaching out, because cold inbound is not gonna. It very rarely will ever work. And I think your point, if you can create a message and have a reason and for the time of an investor and understanding their portfolio, understanding where they're looking and where you would fit in and how you can make a contribution and help each other. I think that tailoring that messaging, whether it's someone introducing you or how you get in front of them, is super important.
All right, so thank you both, and thanks to everyone here.
I really feel passionate about sharing the San Diego talent, elevating San Diego, because it is the best place to be an entrepreneur.